In August 1971, the United States government performed one of the most important financial moves in modern history. With a single television speech, President Richard Nixon ended a promise that had existed for generations. Overnight, the world's most powerful currency stopped being backed by gold. Most people barely noticed. But that decision changed the future of money, inflation, debt, housing prices, and the global economy. To see why this mattered, we have to look at the system it replaced. After World War II, global leaders met in Bretton Woods, New Hampshire, to build a new financial order. They established a rule that would define global commerce for decades. A paper US dollar was essentially a physical receipt for gold. The mechanic was simple. If a foreign government handed the United States a paper dollar, they were legally entitled to receive physical gold in return at a fixed rate of $35 per ounce. This physical tether created global trust. International markets held US dollars because the currency was anchored to a tangible, finite commodity rather than just a political promise. This system imposed a strict limit on government power. Under Bretton Woods, a nation could not print more money than it could back with the actual metal sitting in its vaults. That limit became a problem in the 1960s. The United States dramatically increased spending to fund the Vietnam War and a massive expansion of domestic social programs. This created a mathematical mismatch. As shown here, the United States was printing far more paper dollars than it had physical gold to back them up. Foreign nations did the math and realized the American vault was technically overdrawn. They saw that if every country asked for their gold at once, the United States would have to admit it was broke. A global bank run began. Countries like France and Britain rushed to exchange their dollars for gold, draining the American reserves at a rate the U.S. could not sustain. The superpower was financially bleeding out. The gold standard could not survive a reality where the paper claims in circulation far outweighed the physical assets. By August 1971, the U.S. was weeks away from running out of gold. If the drain continued, the government would be forced to admit it could no longer honor its international obligations, a sovereign default. On August 15th, President Richard Nixon interrupted national television to announce an emergency measure that would break the system. Nixon closed the gold window. He unilaterally suspended the ability for foreign governments to exchange their dollars for gold, effectively ending the Bretton Woods Agreement. To calm the public, the president explicitly stated that this was a temporary measure designed to stabilize the dollar and defend it against international speculators. But the policy shift was a permanent break. By refusing to pay out gold, the U.S. abandoned its promise to the world and changed the definition of a dollar from a physical asset to a government obligation. This was the birth of a pure fiat currency. The dollar was no longer tethered to a commodity. It was now backed only by government decree and the public's willingness to use it. This required a shift in global psychology. For the first time, the world's primary reserve currency had no intrinsic value, only the value assigned to it by the market and the state. Other nations had little choice but to follow. Without a gold-backed alternative, the international community adapted to a system built on faith and credit rather than physical metal. The temporary suspension never ended. Global finance transitioned into a permanent state of floating exchange rates, where the supply of money was no longer limited by the amount of gold in the ground. Removing the physical limits of gold gave central banks a level of operational flexibility they had never possessed. They were no longer restricted by the slow pace of gold mining. Governments now had the authority to expand the money supply at will. They could conjure currency out of thin air to manage economic crises, fund deficits, or stimulate growth through credit expansion. This altered the mechanics of banking. It fueled a massive expansion of lending and provided the liquidity necessary for the growth of complex financial markets. Economic policy moved away from the management of scarce resources. Instead, it became an experiment in using debt and money creation to drive consistent, credit-fueled growth. Without the natural brakes provided by gold, the global economy entered a state of systemic leverage, where the amount of debt in the world began to dwarf the actual physical assets. The data shows a clear connection between the 1971 decision and modern inflation. When the supply of money can be indefinitely, the purchasing power of each individual dollar begins a long-term decline. National debt levels followed a similar path. Unbound from physical reserves, government borrowing climbed at a rate that would have been impossible under the gold standard. Asset prices reacted accordingly. As more money entered the system, the prices of housing and stocks detached from median wages, driven upward by the sheer volume of newly created currency. Economists still debate whether the Nixon shock was an act of survival or a long-term mistake. The central question remains, did this decision save the global economy from a 1930s-style collapse, or did it lay the foundation for the persistent inflation and debt bubbles we see today? Regardless of the answer, 1971 marked the moment the link between what we spend and what we mine was severed, moving the value of the dollar from the scarcity of the earth to the policy of the state.